At first glance, today's move in the precious metals market appears straightforward. Gold is trading near $4,676.86, silver is hovering around $73.00, and investors are once again debating inflation, interest rates, and the next decision from the world's major central banks. But if you look beyond today's price action, a more important story begins to emerge. Markets often reward those who recognize structural changes before they become consensus, and right now several independent trends are starting to point in the same direction. Monetary policy remains important, but it is no longer the only force shaping the outlook for precious metals. Technology, industrial investment, productivity, and long-term supply dynamics are becoming equally important, creating a market that is far more complex and potentially more interesting than the daily headlines suggest. For much of the last year, investors have viewed gold and silver through a single lens. Every employment report, inflation release, and central bank speech has been interpreted according to one question: will interest rates stay higher for longer? That mindset has dominated market psychology because higher rates typically strengthen fixed income investments while reducing the appeal of non-yielding assets such as precious metals. Each stronger economic report reinforced expectations for tighter financial conditions, while softer data encouraged speculation that policymakers might eventually have greater flexibility. Although this framework remains relevant, markets are beginning to acknowledge another possibility. Inflation is still a concern, but the conversation is gradually expanding beyond demand alone. Productivity has become an increasingly important part of the discussion, driven by rapid investment in automation, advanced manufacturing, cloud computing, and artificial intelligence. If businesses can produce more efficiently, inflation may ease through greater output rather than relying exclusively on slower economic growth. That shift would represent a meaningful change in how investors evaluate the long-term outlook for monetary policy. Artificial intelligence sits at the center of this transformation. Most public attention focuses on software models and digital applications, but the physical infrastructure supporting AI is just as significant. New data centers require vast amounts of electrical equipment, high-performance processors, cooling systems, networking hardware, and power management technology. Building this infrastructure demands large quantities of industrial materials, creating ripple effects across global supply chains. Silver occupies a unique position within that ecosystem. It is both a precious metal and an industrial commodity, giving it characteristics that differ from gold. Investors often buy silver during periods of financial uncertainty, but manufacturers purchase it because its exceptional conductivity makes it valuable in electronics, renewable energy systems, telecommunications equipment, medical devices, and advanced computing technologies. As these industries continue expanding, silver benefits from demand that extends beyond traditional investment flows. This dual role helps explain why silver often behaves differently from gold during major market cycles. When financial conditions tighten, both metals may experience short-term pressure, yet industrial demand can continue strengthening beneath the surface, creating a foundation that is less visible in daily market movements. Investors focused only on futures prices may overlook the slower changes taking place within the physical economy. Supply presents another important piece of the puzzle. Expanding mine production is neither quick nor simple. New projects require exploration, financing, environmental approvals, engineering, and years of construction before meaningful output reaches the market. Existing mines face challenges ranging from declining ore grades to higher operating costs and geopolitical uncertainty. These factors limit how rapidly production can respond when demand increases. Meanwhile, global investment in electrification, digital infrastructure, and advanced manufacturing continues. Renewable energy projects require reliable conductive materials. Semiconductor fabrication becomes increasingly sophisticated. Telecommunications networks continue expanding to handle rising data traffic. Artificial intelligence accelerates investment in computing infrastructure that depends on complex electrical systems. Together, these trends create a diverse base of industrial demand that develops independently of short-term market sentiment. This difference between financial markets and the physical economy is essential. Financial prices react instantly to new information because expectations change rapidly. Industrial demand changes more gradually because factories, infrastructure projects, and technology investments operate according to long-term planning cycles rather than daily headlines. Understanding both timelines provides a more balanced view of where the precious metals market may be heading. As investors continue focusing on inflation reports and central bank expectations, another reality deserves equal attention. Financial markets and physical markets rarely move at the same speed. One responds almost instantly to changing expectations, the other changes gradually as businesses invest, factories expand, and supply chains evolve. Understanding the difference between those two timelines is one of the most important advantages an investor can develop because many of the biggest commodity trends begin long before they become visible in daily price action. Financial markets are driven by expectations. A stronger employment report can immediately push bond yields higher. Inflation data can change forecasts for future interest rates within minutes. Currency markets react almost instantly as traders adjust positions based on new information. Gold and silver prices often move alongside those expectations because investors constantly reassess the opportunity cost of holding precious metals. The physical market operates very differently. Manufacturers do not alter production schedules because one economic report exceeded forecasts. Technology companies do not suspend infrastructure investments after a single central bank speech. Utility companies planning large renewable energy projects continue executing multi-year strategies regardless of temporary market volatility. Industrial demand follows long-term planning rather than short-term financial sentiment, creating a dynamic that often goes unnoticed during periods dominated by macroeconomic headlines. Silver sits directly between these two worlds. It functions as a financial asset during periods of uncertainty, while simultaneously serving as a critical industrial material across a growing range of technologies. This combination makes silver more sensitive to changing economic conditions than many other precious metals, but it also gives the metal multiple sources of long-term demand. The continued expansion of artificial intelligence highlights this relationship. Public discussion usually centers on software, but every AI model ultimately depends on physical infrastructure. Data centers require advanced electrical systems capable of operating continuously under demanding conditions. Semiconductor manufacturing depends on increasingly sophisticated production facilities. High-capacity networking equipment must support enormous volumes of information moving across global digital networks. These investments require years of planning and billions of dollars in capital, reinforcing demand for materials essential to modern electronics. Renewable energy provides another structural source of consumption. Expanding solar generation, modernizing electrical grids, and improving energy storage systems all require reliable conductive materials capable of delivering high performance over long operating lifespans. While economic cycles may influence the pace of individual projects, the broader transition toward more advanced energy infrastructure continues across many regions of the world. Transportation is undergoing a similar transformation. Modern vehicles incorporate significantly more electronic systems than previous generations, increasing demand for specialized electrical components. At the same time, industrial automation continues spreading throughout manufacturing, logistics, healthcare, and communications. Each of these developments contributes to a broader trend in which advanced technology requires increasingly sophisticated materials. Supply, however, cannot expand with the same speed. Mining remains one of the longest investment cycles in the global economy. Discovering economically viable deposits represents only the beginning of a lengthy process involving geological studies, environmental reviews, financing, infrastructure development, engineering, and construction. Even after production begins, maintaining consistent output requires continuous investment and operational efficiency. This imbalance between gradually expanding demand and slowly responding supply creates one of the defining characteristics of commodity markets. During periods when production struggles to keep pace with consumption, inventories often become the balancing mechanism. Existing stockpiles satisfy demand, while new production gradually catches up. Yet inventories are finite resources. If deficits continue over long periods, the available cushion becomes progressively smaller, increasing the market's sensitivity to future disruptions. Investors should therefore monitor not only prices but also broader indicators of physical market health. Production trends, industrial investment, infrastructure spending, and inventory movements frequently reveal conditions developing beneath the surface of financial markets. These indicators rarely dominate daily news coverage, yet they often provide valuable context for understanding longer-term price behavior. Currency markets introduce another important variable. Because precious metals are traded globally, fluctuations in exchange rates influence purchasing power across different economies. A stronger US dollar generally creates headwinds by making dollar-denominated commodities more expensive internationally. Conversely, a weaker dollar often improves affordability for overseas buyers, providing additional support for demand. While exchange rates fluctuate continuously, they remain an essential part of the broader macroeconomic environment, affecting precious metals. Inflation expectations also continue influencing investor behavior. Persistent inflation often increases interest in hard assets as stores of value, while moderating inflation may reduce that urgency. Yet inflation should not be viewed in isolation. Productivity growth, technological innovation, energy prices, labor market conditions, and global trade all contribute to how inflation evolves over time. As these variables change, policymakers adjust their outlook, and financial markets respond accordingly. Energy markets deserve particular attention because they influence production costs throughout the global economy. Changes in oil and natural gas prices affect transportation, manufacturing, and logistics, while also shaping broader inflation expectations. Geopolitical developments that disrupt energy supplies or shipping routes can therefore influence precious metals indirectly by changing the outlook for inflation and monetary policy. Investor psychology often amplifies these macroeconomic developments. During periods of optimism, markets sometimes underestimate emerging risks. During periods of uncertainty, pessimism can become equally excessive. Financial history repeatedly demonstrates that market sentiment frequently swings further than underlying fundamentals justify. Eventually, however, longer-term structural trends tend to reassert themselves as evidence accumulates. This is why maintaining a balanced analytical framework becomes so valuable. Instead of focusing exclusively on one variable, experienced investors evaluate multiple indicators simultaneously. Monetary policy influences financial conditions. Industrial demand reflects economic activity. Mining supply determines long-term availability. Currency movements affect international purchasing power. Technology investment shapes future consumption. Geopolitical developments influence both supply chains and investor confidence. Taken together, these factors create a far more complete understanding of the precious metals market than any single headline ever could. While short-term volatility is inevitable, the broader structural picture continues evolving through gradual changes in production, consumption, investment, and innovation. Those slower-moving forces may ultimately prove more influential than the daily fluctuations that dominate financial news. As the market moves forward, the most important question is no longer whether precious metals will continue experiencing volatility. Volatility is a permanent feature of financial markets and will always accompany major economic transitions. The more meaningful question is whether the forces currently shaping gold and silver represent temporary reactions or the early stages of a much larger structural cycle. Answering that requires looking beyond individual data releases and examining how multiple long-term trends are beginning to intersect. Central banks remain a major part of the story. Every policy meeting, inflation report, and employment release will continue influencing expectations for future interest rates. Financial markets will likely remain highly sensitive to these developments because borrowing costs affect everything from bond yields to equity valuations and currency movements. Gold and silver will continue responding whenever investors revise their expectations regarding monetary policy, just as they have throughout previous tightening and easing cycles. Yet history suggests that monetary policy rarely acts alone. Commodity markets have always been influenced by a combination of financial conditions and physical fundamentals. Sometimes those forces reinforce one another, at other times they move in opposite directions, creating periods during which prices appear disconnected from underlying supply and demand. Those disconnects can persist for months, but they rarely last forever. Eventually, markets are forced to reconcile expectations with reality. One of the strongest structural themes supporting that reality is ongoing technological investment. Around the world, governments and private companies continue committing enormous capital toward artificial intelligence, cloud computing, semiconductor manufacturing, electrification, and advanced industrial automation. These are not projects designed for the next quarter. They are investments expected to shape economic growth for years. As these industries expand, they create sustained demand for specialized materials that cannot easily be substituted without sacrificing performance. Silver remains uniquely positioned within this environment because it combines monetary characteristics with industrial utility. Investors may purchase silver as a store of value during uncertain periods, but manufacturers rely on it because of its exceptional electrical conductivity and reliability in demanding applications. That combination means silver benefits from two separate demand streams operating on different timelines. Financial demand can fluctuate rapidly as investor sentiment changes, while industrial demand tends to develop more gradually through long-term production and infrastructure planning. Supply remains the other side of the equation. Mining projects require significant investment, years of development, regulatory approval, and operational expertise before additional production reaches the market. Even existing operations face challenges associated with declining ore grades, rising costs, environmental requirements, and geopolitical uncertainty. These factors limit the industry's ability to respond quickly whenever demand strengthens unexpectedly. Because supply adjusts slowly, inventory trends become increasingly significant. Healthy inventories can temporarily absorb disruptions or production shortfalls, allowing manufacturers to continue operating without immediate shortages. However, if inventories continue declining while demand remains resilient, the market gradually loses that flexibility. Investors who monitor these developments gain insight into underlying conditions that may not yet be reflected in short-term price action. Energy markets also deserve continued attention. Oil and natural gas influence transportation costs, manufacturing expenses, and inflation expectations throughout the global economy. Significant changes in energy prices often ripple across supply chains, affecting production costs for countless industries. Geopolitical developments capable of disrupting energy markets therefore have implications extending well beyond the energy sector itself. Precious metals frequently respond because inflation expectations and investor risk appetite are closely connected to developments in global energy markets. Currency dynamics remain equally important. The strength or weakness of the US dollar influences commodity pricing worldwide, affecting purchasing power for international buyers and capital flows between asset classes. A stronger dollar can create temporary headwinds for precious metals, while a weaker dollar often provides additional support. Understanding these relationships helps investors evaluate market movements within a broader macroeconomic framework rather than interpreting every price change as evidence of shifting fundamentals. Perhaps the greatest challenge for investors is separating short-term noise from long-term signals. Financial news operates on a rapid cycle, in which every data release generates immediate commentary and market reactions. This constant flow of information can create the impression that the entire investment landscape changes every few days. In reality, the most significant economic transformations usually unfold gradually. Infrastructure projects require years to complete. Technological adoption occurs over decades rather than weeks. Mining capacity expands through long development cycles. These slower-moving trends often exert greater influence on long-term commodity prices than temporary fluctuations in investor sentiment. That perspective encourages a more balanced approach to market analysis. Rather than relying exclusively on predictions about the next interest rate decision, investors benefit from monitoring multiple indicators simultaneously. Inflation remains important, but so do productivity gains, industrial investment, mining supply, energy markets, currency movements, manufacturing activity, and infrastructure spending. Each variable contributes a different piece of the overall picture, making comprehensive analysis far more valuable than focusing on any single headline. Artificial intelligence illustrates this principle particularly well. The technology has attracted enormous public attention because of its transformative potential, yet much of the discussion centers on software capabilities rather than physical infrastructure. Behind every AI application lies a network of data centers, processors, electrical equipment, cooling systems, and advanced manufacturing facilities. Building and maintaining this infrastructure requires sustained investment over many years, reinforcing demand for industrial materials that support these technologies. Whether financial markets appreciate that reality immediately or gradually, the underlying investment continues. Looking ahead, investors should expect continued periods of uncertainty. Economic growth may accelerate or slow. Inflation may prove more persistent than expected or moderate more quickly. Central banks may adjust policy according to evolving conditions. Financial markets will respond to each development, creating opportunities as well as volatility. None of these possibilities changes the importance of understanding the broader structural landscape shaping precious metals. The central lesson is straightforward. Markets often become consumed by short-term narratives, but lasting trends are usually built on deeper economic foundations. Gold and silver are influenced by monetary policy, yet they are also shaped by industrial demand, technological progress, resource availability, and global investment cycles. Recognizing how these forces interact provides a more complete understanding of where the market may be heading over the long run. Ultimately, successful investing is rarely about predicting every short-term move. It is about identifying durable trends, managing risk responsibly, and remaining adaptable as new information emerges. The precious metals market continues evolving alongside profound changes in technology, manufacturing, and the global economy. Those developments deserve attention not because they guarantee any particular outcome, but because they provide essential context for understanding the opportunities and challenges likely to shape the next chapter of the gold and silver markets. This discussion is intended for educational purposes only and should not be considered financial or investment advice. Every investor has different objectives, financial circumstances, and risk tolerance. Careful research, disciplined decision-making, and a long-term perspective remain essential regardless of market conditions. As the coming months unfold, the investors who distinguish temporary market noise from meaningful structural change will likely be in the strongest position to evaluate whatever opportunities emerge next.